Hello, everybody. Thank you all so much for tuning in today's show. My name is Ben Epstein, and welcome back to the BRICS Epstein Files. I am super thrilled that we get everyone here to join us today. We're going to go and take a very deep look at how the United States' federal, financial policies and how its own banking rules are systematically turning other countries and investors away from the dollar. So we're going to really dive into showing how the very architecture that holds up the dollar's dominance is, in a way, proving to be its greatest vulnerability. So here we're going to look at the internal mechanics, and we're going to show how, the regulatory decisions are speeding up the demand for alternatives for BRICS countries to develop their own financial alternatives and payment systems to get away from the issues that the dollar's regulations and its political after effects have. So as always, I want to encourage you guys to share your own thoughts in the comment section. If there's any questions, any comments, and any topics you want us to cover in the next program, it's something that I always take, pride in reading your guys' comments. So please be sure to let me know. And without further ado, guys, let's open today's Epstein files. Okay. So to sort of set the groundwork for the understanding the internal mechanics of the United States' Federal Reserve, as well as the how the regulatory decisions are impacting the financial sector, I want us to sort of look at the speech that was made by Fed Governor Stephen Miran made recently over arguing the regulatory dominance of the Federal Reserve's balance sheet. So this is regulatory dominance is a very important and a key concept. For decades, when we talked about the size of the Federal Reserve's balance sheet, this is in the scale of trillions of dollars, mind you. The assumption was that it was merely just about monetary policy. But, the Fed buying bonds to stimulate the economy or call markets in a crisis. But the whole premise has now fundamentally shifted. And it really has, as Miran has argued in his speech, that the sheer size of the Federal Reserve's balance sheet today is less dictated by the inflation targets that are normally shown to be the reasoning of such, and more towards this idea of regulatory dominance. So, after the 2008 financial crisis, we had a lot of new reforms, specific liquidity rules, and leverage ratios that became non negotiable for banks. And these rules effectively forced a lot of the big financial institutions to hold a lot of amounts of safe, low risk assets. These safe assets are normally what you think of these United States Treasury bonds, because it's a structural mandate to have these risk-free assets for these banks to hold on to for reserves. So the regulations are demanding the banks to have uh, these reserves in case of a crisis. So they have to hold these huge piles of cash. And exactly the cash at the central bank reserves in this these massive quantities is creating this permanent structural demand for these dollar assets, which has locked the United States into a system which he describes in his speech that calls a permanently large Fed footprint. So the Federal Reserve is not just this temporary market player who is stepping in and out. It's become sort of a giant utility company that the whole financial world is mandated to use. And it has to keep this massive presence just to keep the lights on for the banking sector. And that's the thing. Maintaining that permanently large footprint has very serious politically toxic consequences. So here in the United States, we could say, sure, this massive, the Fed governing these decisions with a massive balance sheet is keeping things stable. But it's also creating huge controversy because of specific regulatory requirements. The interest on reserves, or IOR, and the controversy over the interest payments is because the Fed is forcing these banks to park these massive tools of cash, and then it feels compelled to pay them interest on those reserves. And we're talking billions of dollars flowing from the central bank back to the financial institutions it's supposed to be regulating. So that in of itself is a core vulnerability. The regulator is paying these massive sums to the banks it oversees, which obviously is a major optics problem. But not only this, it also constrains the Federal Reserve's ability severely to maneuver, especially in terms of a crisis or during times of high inflation. Therefore, we could see that the central bank in of itself is actually hampered by the very rules it has placed itself for stability's sake. So now just from the political jargon, what about like the actual technical plumbing of the financial system? Well, the architecture for this intermediation is incredibly fragile. And what this means is that the flow of money between financial institutions is incredibly sensitive. The United States is constantly having to tweak its own internal rules, like the supplemental leverage ratio or money market fund rules, just to keep its own highly regulated system from seizing up on itself. And so, as this system becomes that much more complex, just to maintain this dollar stability, it's coming at this massive internal cost. And all of these constant tweaks that are trying to be made right now is a signal of the fragility of the United States' financial system. And so the United States is basically tied up under all these technical knots just to stabilize their own house. But what about the external political actors? Countries like, Russia and China, but also allies across the world. It is a massive unmitigated risk because of the Federal Reserve's massive balance sheet. They are also need to be in tune with the United States Federal Reserve, and realizing that the amount of power and dominance this central bank has makes their country in particular incredibly vulnerable. They're exposed to sudden shifts in United States interest rates, but also to a lot of the regulatory spillovers that we'll see. So, how can a little tweak in how can like a little accounting rule in DC cause a headache for a financial advisor that's in Jakarta? Well, when the United States adjusts its capital requirements for banks, it's instantly changing the global appetite of the major banks to lend to these foreign markets. So, if the United States suddenly needs more high quality liquid assets, they might sell off they may sell off a lot of, debt from emerging countries, even if the local fundamentals have not changed for that country whatsoever. And that could cause a massive financial crisis in that country. And that country needs to obviously and adapt its rule basing and rulemaking process to these incredibly powerful financial institutions, not just in the United States, but also the Federal Reserve itself. And for a lot of these BRICS countries, we don't just see the dollar system right now as unstable. They are seeing it as a weaponized form of political control. And obviously, relying on the dollar's current infrastructure is making it constrained to an enormous amount of sanctions that the United States can pose on countries, like being cut off from the SWIFT system, And we can see that as the dollar has changed from a neutral good of exchange to more of a conditional tool as the United States' foreign policy, now the initiatives for BRICS countries, but also countries all over the world, are super clear. They want financial sovereignty, and reducing their exposure to the constraints that the dollar and the Federal Reserve provides is how this is going to happen. So now that we've sort of outlined the why we're seeing a lot of this migration towards United States centric, the dollar system itself, let's kind of look at more of the rules and also the options that BRICS countries are developing now to de-dollarize and regain their financial sovereignty in just a second. Yeah, swift weaponization, these are just the catalyst, the rest are just the consequences. Yeah, Ernest Castillo, I agree. And, the United States thought that they could really hit people over the head with, the dollar through these sanctions. And all it's doing is isolating itself further and further away from a truly evolved multipolar financial system because they don't want to give up the obvious power and the leverage that the dollar has right now in the financial markets. Okay, so now let's discuss a little bit more about not just the changes in the United States regulatory requirements, but also the initiative by the BRICS countries. So, when we're talking about a high stakes battle over the capital rules and specifically the SLR, which is the supplementary leverage ratio, right now this is an incredibly critical issue, even though it sounds very technical and very boring, really. So for the country's biggest financial institutions, or what they'll call GSBs, which are globally systematic important banks, they have higher and higher requirements for the amount of leverage that the bank can take on because of the balance between the efficiency but also liquidity, or the resiliency and the liquidity of the market. I'm sorry. So it right now the leverage ratio is sort of a blunt fail-safe idea that was passed out of the 2008 crisis, and it required banks just to hold capital purely on the raw size of their balance sheet. But now that we're seeing a lot of these big financial institutions argue that this tool, this SLR, is actually becoming a drag on the economy, especially in the United States Treasury market. And now, on one side, you'll get these detailed reports from industry think tanks and groups like the Bank Policy Institute saying that the current SLR is a constraint that harms market liquidity. But on the other hand, you can see the Systematic Risk Council, or SRC, and other important lawmakers just see this as a means of deregulating the industry more. Now, what it comes down to, what should be prioritized, should it be maximum being as resilient as you can be, or having the biggest market capacity you can have? So when we talk about raw leverage compared to SLR, raw leverage is just about a simple size, and it completely ignores risk. And that's a massive, massive part of this problem. Most bank capital rules are what we call risk-based capital. And those, if you hold safe assets, you need less capital than if you hold the risky ones, right? Now, with the SLR, that throws all of that out the window. SLR is just a simple ratio, and a bank's tier one capital its core capital relative to its total leverage exposure, or TLE, which basically encompasses everything they own. That is what's being held down at this for these massive financial institutions having a 5% minimum ratio of their SLR, because this ratio includes everything, not just the balance sheet itself, but all their off balance sheet things such as like derivatives products. And this, like I was saying, is the conflict. It's under normal risk-based rules, these treasuries and these reserves at the Federal Reserve have a 0% risk weight. That's completely risk-free. That's considered risk-free, which makes sense because they're backed by the government or their cash. So as long as the government is still there, they will be able to pay you back at once your bond comes to mature. But they're the safest things a bank can hold. Under this SLR, those risk-free assets are going to get the same exact weight in that denominator as much riskier other options like corporate loans or mortgage-backed securities, which was something that a lot of banks bought a lot of before the crisis hit because they thought it was a safe asset. Lo and behold, it was one of the biggest reasons that sparked the financial crisis to begin with. So if the SLR just stops being a backstop and becomes what they're going to be calling this binding constraint for banks, that means that the bank is going to be held down by this simple size rule, not a smart measure that actually accounts for the actual riskiness of the assets that it holds. So the industry view, like people from the BPI will call the efficiency argument, is that they're really hurting to operate in the Treasury market because of these constraints. They point out that 3 of the 6 biggest bank holding companies are currently bound by this ESLR. And for them, the consequences are just simple economics, right? They're disincentivized. So why would a bank want to use its most expensive, precious, high quality capital to handle a low margin trade of a very risk-free asset like a treasury bond? Well, truthfully, when the differences are incredibly stark, when it could be that the exact same slice of capital to underwrite a much higher return that you would get from a corporate deal compared to just a treasury bond, the math just doesn't work out for them. And the data shows that it's very striking. So since 2007, the total amount of outstanding treasury debt has grown almost 4 times relative to the primary dealer's balance sheet. So the capital rules have not kept in place with this massive, massive explosion in government borrowing that we saw a lot, especially during the COVID pandemic. And this is where their argument pivots, where it's not just about their profits, it's about what they're calling the stability of the entire market. Now, ironically, yes, during stress, investors would want to flee to safety, pour their deposits into, very risk-free assets and things like that. But if those deposits are forced to hold, or if those banks are forced to hold more reserves, it'll make the reserve requirement, that denominator, a lot bigger. And it turns into this vicious cycle. And we saw this during COVID. The market completely seized up. Dealer capacity was overwhelmed overnight, and the Federal Reserve had to step in with massive asset purchases, quantitative, to get the treasury market working again. Now, because of the whole purpose of this SLR is supposed to be a risk agnostic guardrail. It's there to protect against the inevitable failure of these risk-based capital models that have been made and are being completely or increasingly less reliable because of how they want to tweak how they are measuring the riskiness of these assets and how they want to transform this leverage ratio for these bigger banks so they want to hold less reserves. So back in 2008, the RBC rules assigned very low risk weights to these mortgage-backed securities. And these banks loaded up on these safe assets. I mentioned this before. And when the housing market turned, the risks were all correlated and the whole system came crashing down on them because the RBC rules incentivized that very behavior to cause that crisis. And we don't have to go back for another example, not too far. Silicon Valley Bank failed and went bankrupt in 2023. That was about United States Treasuries, the safest asset. SVB did not fail because of those bad loans. It failed because of its huge holdings of long-dated United States Treasury securities that were 0% risk-weighted assets, had massive unrealized losses because of when interest rates started to climb and made SVB incredibly vulnerable. So I know that this was I know that this was very technical, but I guess I want to just emphasize something. This is sort of this concept of regulatory dominance that we were first discussing. The decision on the SLR, this ratio, is going to directly impact the size of the Federal Reserve's balance sheet. And therefore, it's going to impact how it conducts its monetary policy. If the SLR forces banks to hold a lot more reserves, then just to say compliant, then it will artificially increase the demand for these reserves it would have to create this artificial demand, which would keep its balance sheet a lot bigger and makes its footprint stay as big as the governor called out in his speech. So, but on the other hand, the more that they need to increase their balance sheet, like we talked about, the more that they are unable to adjust to a lot of the monetary policies and regulations that a lot of the financial institutions are pushing, and it makes the Fed completely frozen in its own system, and it cannot do anything to stop the declining role that the United States dollar has in other central banks' holdings, as well as a medium of exchange. So the Federal Reserve is very, very stuck. And we can see for a lot of countries, not just in the BRICS bloc, but across the world, they see that the combination of the dollar being used as this political weapon, but also the fact that their central bank cannot control its actions or what it wants to do because of the technical knots and bindings it put on itself. It is causing a lot of the BRICS countries, but every country, to find better, more meaningful alternatives. And that's what we're really seeing now with the rush of, Russia recently pushing for cross-border, increasing the role for cross-border payments, as well as, China coming up with its own digital payment system and things of that nature. So now that we've sort of gotten a really big picture and understanding the nuances of why important ideas like the SLR and the idea of regulatory capture is pushing the dollar's irrelevance even further or making it even less relevant faster. Now let's quickly pivot to how many of the BRICS countries are dealing with it and creating the alternatives for a better multipolar future in just a minute. Yeah, Don Hooligan. Yeah, so the Glass-Steagall Banking Act was something that was incredibly important before Bill Clinton ruined it, but it basically was able to separate what commercial banking was with investment banking. And the Glass-Steagall Act is something that was incredibly important, especially after the financial crisis that led to its enactment. So, for the United States, it's going to have to figure out a way to move itself back to that position, so it can make itself way less exposed to a lot of these riskier assets. But I doubt that they're going to do that. So we'll see how Jerome Powell and the Fed sort of are going to be dealing with this in time. But now, sort of as our final topic, I want to now talk about how the BRICS alternatives. So right now, we are seeing that the United States has basically put itself in a situation where no one can trust the dollar. No one can trust the, not just the dollar, but also the SWIFT system, which was absolutely foundational as a means of international transfer. But because of the United States using this as political leverage, it is making the SWIFT system far less reliable and far less important for BRICS countries to even use now. So now let's talk about the BRICS. Let's talk about two key points about the BRICS alternatives right now. So we have the first proposed payment network, which is known as BRICS Pay. And the second, which is the lending engine, is the New Development Bank. So obviously, we talked about how what motivated BRICS to even come up with these instruments to begin with. They want the financial sovereignty that is very limited right now under the G10's central bank controls. But obviously, and wanting to have resilience from sanctions that the United States would pose on countries if they didn't go along with their foreign policy or anything of that nature. So, BRICS Pay. BRICS Pay was a very, very, very big talking point at the Kazan summit in 2024. We've done a lot of videos and there's a lot of articles posted on our Substack and our YouTube channel that goes into the Kazan summit and also BRICS Pay. But this is where the complexity of BRICS Pay is. It's designed to be it's basically to make cross-currency trade a lot smoother, making local currency and cross-border settlement transactions, more robust. And specifically, when we're talking about this, what makes it very interesting is it's actually going to be linking up a lot of the national payment systems into one big framework. So a lot of these different systems, like India's unified payments interface, will actually be able to handle peer-to-peer payments, billions of them almost instantaneously. And then you have China's cross-border interbank payment system, which is known as CIPS, which is already an alternative to the SWIFT and is mainly used in their own currency, but it does not. But it also allows for local currency transactions and also linking up with other interfaces to make the transactions a lot more robust. So, for one thing, what is really getting in the way with making these systems readily available to people like you and I? Well, for one thing, it is like we've been talking about before. It's sort of coordinating the regulations between all of these different countries, right? Like, it could be a very big headache to switch, uh, to alternate between these systems and technology, especially when you have to deal with, political hurdles or anything like that. So instead of one big central hub, this is designed to be more decentralized and lets all the participating banks record transactions at the same time. So if India and China are trading, for example, these details get locked, across these multiple ledgers simultaneously. And that's honestly what is the most fascinating thing, because a lot of people have complained about the efficiency, but also just how the Swift system has not innovated itself in a very, very long time, which is how BRICS Pay will be able to take the torch as a cross border payment system and be able to talk to a lot of these national payment systems as well to, make Swift a lot less usable or a lot less needed. Really, if you can have national systems talk to each other, that it would be a major innovation, because it, allows, regulations within the own national or their own nation to coordinate with this system and make it easier even during times of, political crises or things of that nature. So, you know, but one thing that's also needs to be said, obviously, about this cross-border payment system is that obviously it doesn't make sense to use it without having capital for big projects. So when you have BRICS Pay on one side, you have the new development bank on the other side. And we've had a lot of different interviews and discussions about the new development bank. We had a recent interview too from a former, vice president and founder of the new development bank, which I highly, highly encourage you to watch. It is a very, very interesting interview. But the new development bank, which, was, came out in 2014, it is a challenge to these Bretton Woods institutions that have systematically made it a lot harder for countries to develop because of the policies that they've recommended. And the new development bank will have the resources for projects for infrastructure and sustainable development across all the countries in the global south. So the very interesting thing that separates the new development bank from an institution like the World Bank is the voting power. And there are 5 members, and there is no veto. Everyone has nearly equal voting. And this just goes to show that the veto power is a major, major roadblock from the World Bank becoming more relevant, or the IMF, because the United States has a veto over it. So with, since no single member can make a decision, it can bring in a lot of major borrowing countries like Egypt and the UAE, and, and Bangladesh, for example, for a lot of these projects. So in 2023, the net profit for the new development bank was $600 million. But what's crucial is the money that was going out to the borrowers' disbursements nearly tripled, nearly $3.4 billion just that year. And the cumulative approval since they started, this now is almost at $35 billion across more than 100 projects. And that in of itself makes the new development bank a very serious player for a lot of the developments in this multipolar financial system that is sprouting up before our very eyes. Brazil has approved infrastructure programs in Aprecia de Goiânia, not just roads, but also, streets and bridges, schools. In India, there was the Gujarat Rural Road Project, which had nearly 11,000 kilometers of new road giving all weather connections to around 2,800 villages for the very first time. Like, for them, think of the impact to get their crops to market or getting out of the hospital. That in of itself, that project is absolutely massive. These are essential projects. And when we talk about the projects that we see with the IMF, a lot of their requirements, or a lot of what they would consider the best policy decisions, rely on austerity measures, which is basically cutting cutting social spending, reducing the deficit as much as possible. And that is an incredibly dangerous game to play, because not only does those policies not work, it doesn't help the country grow in any long-term sustainable manner. And hollowing out the public sector just to, pay your creditor in this case, it makes the social situation completely unravel within that country. We've seen sanctions, like from sanctions to Venezuela, for example, um, and those austerity measures. There is a long list of examples on how the IMF's structure and the way it has, and its policy decisions have steered countries in the complete opposite direction. So this is all to say is that the BRICS pay system and the new development bank are ones that are these are successful steps that are pushing us towards a system of independent financial resilience that is not influenced by any foreign policy or any one government's demands. The performance of the new development bank, the technology and the coordination behind BRICS pay, it shows that this parallel structure is viable. And over time, since the goal is financial autonomy, the more and more that they develop these systems, and the more and more the United States is battling themselves, not just externally with sanctions and other means of financial coercion, but also unable to do anything about the situation internally, makes the new development bank and BRICS pay the two best options in terms of a BRICS financial payment system in the future. And it shows that the United States is becoming less and less relevant in the financial sector, considering how they use their financial instruments as a means of political coercion. So that's all I have to share with you guys today. I know that this was like a really technical subject, but I really did want to highlight it because it really goes to show how the United States is not just losing around the world, but its system is also tearing itself apart internally because of the system it designed for itself and is unable to do anything about. So I am going to close the BRICS files for today. I do want to thank everyone sincerely for tuning in today. I hope you guys found this as a very interesting discussion. Please let me know what you guys think in the comment section, as well as keep posting, your questions and any topics or anything like that that you guys want me to talk about next time. And until next time, guys, I want to thank you all for tuning in today, and I will talk to you again soon.